the lower end the most. The last 2 or 3
Hey everyone, can you guys hear me?
Yes.
Hey, okay, it is start of class, so we'll get started, and I'll start with just kind of what I've how I've done it the last few times, which is any questions that anybody has specifically about last week, the lecture last week or the readings. Let's take a few minutes right now, just while people are still getting on, and see if there's anything there. I didn't see any. I didn't see much in on Canvas, so hopefully that means
Hi, Jay. I have a question
yeah, actually,
about
just could you guys just use the raise your hand so I could just see who's asking the question? Okay, so MD.
yeah, my question is the indices. Sometimes it's multiple of 30, sometimes it's multiple of 16. What is the reason behind that? Is there any way to figure it out why sometimes it's 16, sometimes it's 30?
I didn't hear the first part of your question. You said, are you asking for the multiple for the market generally, or?
Yes, market
Okay.
of like S&P 500.
Right. So the question, just I'll repeat the question just so everyone can hear it. The question MD is asking is, sometimes the multiple on the market is 16 times, sometimes it's 30. Today it's like closer to 25. Why is that the case? And we'll go into the lecture today and really also next week. But I think the thing that the thing that I think is most important to keep in mind is what's the broader context in terms of where are things like interest rates, and other, sort of asset classes. And so what are the relative returns? So historically, you'll see that the P multiple on the market has been low, which is an alternative way of saying that the earnings yield on the market is relatively high when interest rates are relatively high. And alternatively, when P multiples are high or the earnings yield on stocks are low, historically has also been when interest rates are low, right? Because in the end, on the margin, all assets, all asset classes have to be somewhat competitive with each other, not perfectly competitive, but obviously people expect to get a higher return from equities versus bonds. But, if bond rates are low, generally speaking, people will say, well, okay, there's no place to be. There's no other alternative to be in stocks. They raise the value of stocks, lowering the yield on stocks, raising the multiple on stocks, and vice versa. So I really think about it mostly as a function of where are other asset classes, and in this case, where interest rates are. One of the things next week we'll do is actually go into a lot more detail on some of that stuff. Any other questions? Anyone else has? David.
Yes. So I think one of the articles for last week, the article about Cisco, I don't think I missed it, but I don't know if we touched upon that at all. I just assume it was the guy who wrote the article was way off and took us forever to
Well,
Cisco.
it was purely right. That was an optional reading, and it was pure. I purely put it out there just to, just to show you kind of like, that was an article. Obviously, that was an article published 20 plus years ago, 25 years ago, and talking about how, Cisco's the NVIDIA of today, basically. Think of it like that, right? And so just like how everyone can see just just the green pastures and blue skies, that's how people used to think about Cisco. And I put it there mostly because just like what we saw with those magazine covers, right? People are really bad at forecasting. I mean, that's a long-term future, right? But even a short-term future, people are really bad at forecasting future. So that was kind of the whole genesis of that. That was just a fun article to read. That was the whole reason. But it should have been an optional reading, so that's why I didn't touch on it in the class.
Thanks.
Okay. Any other quick questions? Otherwise, we'll get started, and I'll leave time at the end. Okay, Shanlin, I see. I think you're on mute.
Okay. It's really interesting thinking about the intrinsic value because the way Buffett described it is like the cash you can take out of business during its remaining life. And that's really interesting. I was thinking, okay, what does it mean by that? Because say if I'm running a company, I mean, I've been working as a management, but I was thinking of how do I run that number for the company that was part of the management. And I don't know how to do that. It's like,
Yeah.
do you project
So
10 years or 2000? How do you even do that?
right. Well, in the next hour and a half, hopefully you'll have a lot more comfort, at least on how to at least think about some of that stuff. That's what we're going to do. I mean, a good part of this lecture is really talking about some of the traditional shortcomings of traditional valuation metrics or valuation methodologies. Let me say it that way, and how we can kind of at least try to be a little bit, maybe not precise, but a little bit better about thinking about things like that. So let's get started now. I see about 20 of us are on the class right now. Hopefully a few more people will be joining. And then, like I said, I will leave time at the end for questions and stuff. So let's get started. And then again, like I said, if there's something, if the audio or anything like that, if there's a technical issue, feel free to stop me. But otherwise, we'll kind of leave all the questions to the end so everyone gets a chance to ask the questions. And we can kind of stay on time. So start. Okay, so where are we today? So just again, the agenda for today. I'm just going to do a quick recap of what we talked about over the last few weeks. And then the two topics really are intrinsic value and margin of safety. And we're going to talk about it in a little bit more of a technical detail than probably what the classes have been before. Summarize it with the key takeaways, and then obviously leave time at the end for Q&A and discussion. So where have we come from so far? Can't believe it's already week 5. First week, feels like yesterday, was, we really talked about investing being a loser's game and about the shortfall, or the shortcomings of traditional active management. The second week was really talking about how investors and markets operate. We talked about the concept of an equity yield curve, how professional investors really have a short-termism, how, what Keynes said about the convention, how people generally tend to extrapolate what they currently see into the future. The third week, we talked about how to deal with investment volatility. This was the week we talked about with Peter Lynch. We talked about it with, how God would get fired as an active manager, and how, God can't beat dollar cost averaging. And we really talked about the concept of Mr. Market. And so we're going to build on that a little bit today. And then last week was really more about like how to think like a handicapper, the value of experts and forecasts. And so hopefully what you've seen is that, those things are a little bit. Oh, sorry, I forgot to start the share. My bad. 1 second. Okay. So let me back up. Everyone can see the screen share now. Okay. So again, sorry about that. You would think after 5 weeks of this, we'd have it all smoothed out. Really, week 1, how investing is a loser's game, kind of the why most active managers underperform. Week 2, how investors and markets really operate, the concept of the equity yield curve. Week 3, how to deal with investment volatility. And, why you shouldn't bother timing the market. And then last week was really about how to think like a handicapper, and really taking that sort of mentality towards investing. And then, like I said, the value or really the lack of value from experts and forecasts. So here we are today in week 5, and we're going to talk about two topics. First, what does intrinsic value mean? We always use this term intrinsic value, but what exactly do we mean by that? And then the second related concept is what exactly is margin of safety? And then how can we calculate both of them? And why do we want to know these numbers, right? We want to know these numbers because, as we hopefully remember from Benjamin Graham and the concept of Mr. Market, right? Basically saying that investors should really tune out market prices, right? But doing that requires us to have some confidence in what's the value of our investments, right? It's easy to tune out the market when you know what something is worth. I use the example of, if you had a box with $100 in it, right, and somebody offered you $50, you wouldn't care, right? At that point, you would just tune them out. You say, like, this is crazy. And at the same time, if somebody offered you $200, right, you wouldn't say, like, oh my gosh, I need to buy more of these boxes now, because again, you know what the box is worth to you, and you'd be happy to sell it to them for $200. And so really what Graham is saying is that the only time you should really pay attention to market prices is when you have the opportunity to buy very low or sell very high. And so the main question is, how do we develop confidence in the assessment of value? And so that's where we're going to get to today. So let's just start right into it. Intrinsic value. The first reading was by this gentleman named James Osborne. He's a registered investment advisor. He founded a company called Basin Asset Management. They've actually become just a passive. They just allocate to passive, which I thought is interesting for an investment advisor. And he wrote the article, "Is there such a thing as intrinsic value?" Right. So he is not a believer that there is such a thing as intrinsic value. And here are a couple of his comments. Right. One is intrinsic value is decided by the market. And he says it's odd to state that today the market is wrong about the stock's intrinsic value, but that it expects it to get it right sometime in the future. He says there's no rules about what stocks are worth, and he basically comes to the conclusion they're worth what people are willing to pay for them. That's the value. So the reason I bring this up, first of all, I disagree with this, but second of all, I bring this up because I actually think that this is probably the attitude that most investors in the market have today. They really don't think about market price and intrinsic value as two different things. And hopefully I'm going to do a good job and kind of show you why those things might be different. The second article, which is a rebuttal of the first article, is by an anonymous blogger. He runs a blog called Philosophical Economics. We don't know who he is, but if you ever go on his blog, he's written this. He's written a couple other things that are at least somewhat thought-provoking. I'm not saying that I agree 100% with everything he wrote in the piece I had you read, but I think there was a couple of things that were pretty interesting. So in that article, which is called "What is Intrinsic Value and Who Decides It?" He or she, we don't know if it's a guy or girl, right? He comes up with an interesting way to think about intrinsic value. And he basically says that intrinsic value is the price an investor would pay if she could not sell, right? And in some ways that kind of makes sense, right? When you think about definitionally, when we're talking about intrinsic value, right? Intrinsic means the value comes from the asset itself, right? And not really from what maybe somebody else is willing to pay for it, right? So when we think about how does value come from an asset, right? We talk about things like revenue. Revenue leads to things like earnings. Earnings leads to things like dividends. Dividends is really what gives you value. Charles, I see your hand is raised. Is there a technical?
I have to say this one because when I see this one, I have to say something. Sorry, can I? Yeah. What it says, investor would pay if he could not sell, but some stock they don't even have dividend, right? What's the point? You keep the dividend, keep the stock. There's no dividend, and you get nothing from it. That's the thing I kind of feel odd for this one. It has it's a meaning there, but yeah, if there's no dividend, what are you gonna do with it, right? You don't get anything from it.
Sure. Okay, Charles, can you just
Yeah,
put a pin in that and let's just ask that question at the end, because I think it's a very valid question, and we're gonna talk about it.
Thank
You know,
you.
but let's talk about it at the end. The point is, you know, the point that they make is without intrinsic value, investing and speculation are basically the same thing, right? Because if intrinsic value doesn't exist, what is investing, right? Investing basically tries, all you're going to be doing at that point is trying to guess the direction of prices. And, you know, so therefore it becomes speculation, right? So if intrinsic value is just the price that somebody else is paying, you know, investing really loses all meaning. Now, the other point, which I think is a very valid point and a very interesting point, is that liquidity, right, which we talked about, if you remember, we talked about that with, you know, John Maynard Keynes, The State of Long-Term Expectations. But basically, the point that he's making is that intrinsic value causes the value is dramatically different from the price. You know, it's dramatically different than the price investors are willing to pay if they know they can sell, right? So when liquidity is present, investors tend to view their equity holdings like cash. And most of the time you think about that, right? When you think about your own portfolio or your own net worth, you don't view your stocks differently than necessarily cash that you might have in your bank account, because you know they can both be converted relatively, or you know, stocks can be converted relatively quickly to cash, and then be spent, right? And so that tends to make people value investments, you know, higher than maybe they would otherwise be, or what you would allege to be intrinsic value. And he goes on and he basically says that market prices fluctuate across a spectrum, right? He says about prices hovering between two poles. One pole is the intrinsic value price, which is the price that investors would pay if there was no ability to sell. So you have to hold the asset for the rest of your life. And two, what he calls a bubble price, which is the price you would pay because you know that you can get out pretty quickly, right? Liquidity. This is the same thing. This is, in a lot of ways, these are the same concepts that Keynes has said in a slightly different way. The point that he's making is that because of liquidity, people will pay a price above quote unquote intrinsic value. So let's just think about it through a thought experiment, right? So imagine, you know, you're trying to buy two farms, right? You're looking at two identical farms, and they're identical in every way except for one, right? One can be resold, the second one can't, right? And so when you think about it from that perspective, would you offer a different price for the first versus the second farm, right? And this, in the financial markets, you know, we call this liquidity premium, right? And so when you think about liquidity premium, what you're really thinking about is optionality, right? A buyer would pay more for a farm knowing he could, you know, he could sell it to someone. Maybe someone offers him a higher price. He could get out at what he thinks is a great profit. Maybe he really needs the money. Maybe he decides he hates farming and he wants to become a car dealer. You know, you have the optionality from liquidity that you don't have when you, you know, when you buy an asset and you can't sell. Paying a higher price, by the way, when you think about it, is the same as accepting a lower return. So basically, it's the same as saying that price really fluctuates between these two poles. One pole is the liquidity price, where you accept a lower return knowing that you could get out of an asset pretty quickly, and quote unquote intrinsic value price, which is the price that you would buy an asset and you'd be happy to own it kind of for the rest of your life, right? And so you could also think of it as two ways, as just accepting different levels of returns. And, you know, we see liquidity premiums in the market all the time. So one example, you know, we talked about long-term capital management, right? One of the things that long-term capital management did is they would arbitrage between what they call on-the-run and off-the-run treasuries. So, you know, if you a 30-year treasury and a 30-year treasury issued 6 months ago, so now a 29.5-year treasury should be very close to one another. But people always want to trade the most newly issued bond. And so the one that was issued 6 months ago usually would offer you a little bit higher interest rate than the one you'd buy today. And so one of the strategies that long-term capital management would do is they would buy the off-the-run bond and hedge by selling the on-the-run bond and collecting that small difference in interest over time. There are foreign stocks and ADRs. So an example is, TSMC, Taiwan Semiconductor. So Taiwan Semiconductor obviously trades in Taiwan. And it also has an ADR, American Depository Receipt, where it trades here in the US. And typically what you'd see is that the US version, which has a lot more volume, always trades at a higher price, even when you're adjusting for the exchange rates and everything else than the shares in Taiwan. There are also companies that have dual class shares. So, Google is an example, right? Google has 2 classes of stock. Lots of companies, or a fair number of companies, have 2 classes of stock. Usually one class of stock has more voting rights, but is less liquid because it's owned by the insiders. And then the one that is more liquid has less voting rights, and that's owned by the public. And you typically see that there's a difference, even if the voting rights alone couldn't account for that difference in the price of the different shares. So just some examples that we can observe these liquidity premiums aren't just a theoretical concept, right? We can see them in the markets all the time. One of the interesting kind of takeaways from what philosophical economics is talking about with intrinsic value is, really only productive assets can have intrinsic value, right? When we think about what we call an asset like gold or art, right? You may get a psychic dividend, right? You can look at your bar of gold, you can look at your Picasso hanging up on the wall, right? But it doesn't generate any income on its own, or even some potential for income on its own, which is the question that I think Charles was asking, and I'll talk about in more detail. Its value really comes from the ability to sell it to other people, right? So just think about that when you think about investment versus speculation, right? Investment is where you can generate a return without having to sell the asset to somebody else. And speculation is where you can only generate a return if you end up selling the asset at a higher price to somebody else. Interestingly, right, assets also don't need to trade to have intrinsic value, right? So great examples, right? Houses, they have intrinsic value, right? Because even if you don't sell the house, you could rent it out and you could generate rental income. Private businesses, obviously, by definition, are private. They don't trade. But if you're an owner, you can take out dividends. And so they, again, have intrinsic value. And so the other point that, philosophical economics is trying to make is, we really shouldn't spend too much of our brain cells trying to rationalize market prices, right? Most investors spend a lot of time looking at where something trades and trying to rationalize it based on fundamentals, right? We assume that the price is right and that maybe we don't understand it, or we try to adjust our assumptions to kind of plug into, I mentioned NVIDIA earlier. NVIDIA trades at $200 a share now. Okay, so what does that mean? How can we rationalize, if we want to buy NVIDIA, right? So what we'll see is really prices at best have a loose connection to intrinsic value. And, kind of going back to what we said before, most of the time we should really ignore market prices. And, again, what Ben Graham said is, we should really ignore market prices except for when they're really trading extremes, because when they're trading extremes, we can use the market liquidity, to our advantage. So that was kind of the main points that I wanted to take away from that article. And then we'll move to this guy, Warren Buffett, the Oracle of Omaha, the greatest of all time. 16% basically for what, 60 years. So, you know, that's why he is who he is. And, you know, when you look at the companies, right, Berkshire Hathaway is the only trillion-dollar non-tech company out there today. And, you know, basically, you know, he talks about intrinsic value in the owner's manual, the Berkshire Hathaway owner's manual. And he basically says it's the discounted cash flow value, right? This is what he says. Intrinsic value can be defined simply. It's the discounted value of the cash that can be taken out of the business during its remaining life. What we were talking about before, what is the life of a company and the cash we could take out? Let's talk about that. Now, in his description, he talks about book value. And I think to make it easier, I substituted the word price in it because I think it'll make it easier for us to understand, right? So he gives the example of the college education, right? And so he says you can gain an insight into the difference between the price and the intrinsic value by looking at a college education. So think of the college education's cost as its price. And, you know, when you think about it, you can estimate the earnings that the graduate would receive over his lifetime. So if he gets a college degree, what are the earnings that he would receive? And then if we discounted it at an appropriate interest rate, we'll talk about what an appropriate interest rate is. But that dollar value result is the intrinsic value of the education, right? So basically the way I think about it is what Buffett is saying is that the intrinsic value is the additional earnings that a graduate gets because he gets a college degree versus the earnings that he would have without getting a college degree, right? So it's that increment that you would make, the higher earnings you'd have. And when you think about the, you know, he makes another clarifying point, right? When you think about the cost of a college education, you have to not only think about like the cost of the tuition, but you have to also think about the cost of the foregone earnings that the student would have had over those 4 years had he worked instead of gone to college. Now, what's interesting is, you know, think about somebody like Bill Gates, right? For him, the value of a college education might have been zero or even negative, right? Had he graduated, you know, maybe he would have missed out on starting Microsoft and, you know, would have been a lot poorer. So it's not always the case that, you know, college education has a positive intrinsic value. Obviously, that's, you know, he's a significant outlier. And what he says is that price is meaningless as an indicator of intrinsic value, right? Some will find that the price of the education exceeds its intrinsic value, right? So the cost that you'll pay, you know, if you spend a lot of money on college and you know, maybe you get a degree that doesn't have very much value, you know, you won't see a lot of intrinsic value from the value of a college education. And in other cases, the intrinsic value will far exceed its price, right? You get a college education, you have no prospects before college, you have a lot of prospects after college. The value is maybe quite enormous. But he says in all cases, you know, price is meaningless as an indicator of intrinsic value. So Buffett basically reiterates that, you know, price and intrinsic value are two completely separate things. So let's get to the meat of it, right? Discounted cash flow, right? So this is what Buffett says that intrinsic value is discounted cash flow is the way to calculate intrinsic value. So how does one calculate intrinsic value, right? So here we have, you know, this has been a very formula light class so far, and it's going to stay formula light, so don't get scared. But, you know, here you see P is, you know, price or intrinsic value. And basically all it is the discounted cash flows from now until eternity. So the earnings in year one, that's E1 divided by 1 plus R. R is the discount rate. So some, you know, again, what we, you know, some appropriate rate of interest, discounted that back, discount the earnings in year two back by, you know, the same discount rate on and on and on. Basically, you know, a summation of all the earnings from now to infinity discounted by the returns. This is not simple, right? Okay, well, let's march on, and like I said, bear with me just for a few minutes. Now, most people, most professional investors, they kind of use a shortcut, right? So what they'll do is you'll see most investors will, if they do discounted cash flows, a lot of them don't do discounted cash flows, but if they do discounted cash flows, what you'll see is that they tend to forecast earnings, for a short period of time, let's say maybe 3 years, 4 years, 5 years, and then they use a terminal value. So that's TV terminal value. And then they discount that all back to today, right? So maybe it's a little bit easier. You're not obviously trying to forecast earnings from now until Armageddon, but still, you've talked about how people don't necessarily do a good job of forecasting, even in the near future. So maybe this approach still has some flaws. So I'm going to just take a little side detour, right? Because this question, is going to get asked. So I'm going to answer it right now. So why use earnings instead of dividends or free cash flow, right? And again, this is not meant to be a super technical accounting or anything like that class. I will write a more detailed kind of explanation on this point and post it on Canvas. So if you don't understand it right now, I will post something on Canvas, and so you can feel free to ask me a question, right? But basically, my point is that if the company earns a good return, good return on invested capital or good return on equity, right? The earnings that it retains, right? So the earnings beyond the dividend or cash flow, they still have value, right? And I think a really good example is if you have a bank. Let's say you have a bank account and you have a magical bank account and it happens to pay you 20% interest, right? So you could take that interest out, or you could leave that interest in and let it reinvest and compound at 20%. Now, most of the time, especially today, right, you probably want to leave your money in and let it compound. And so basically what I'm trying to show you is that just because that money isn't paid to you as a dividend doesn't mean that it doesn't have value to you, right? It's sitting in your bank account, generating a high return. And so really that concept is the same for a company that earns high or reasonable returns on capital, right? Which, to be honest, most companies, generally do, right? Few of them don't, but most of them do. So if you didn't understand that concept, what I would say is, I think like I said, for most companies, you'll be fine just thinking about earnings, and not having to worry about things like dividends or free cash flow. But again, I'll post a more detailed explanation on Canvas, because I know this is a point that will come up in the discussion. So we talked about discounted cash flow. Now, I think there's a fair number of shortcomings for discounted cash flow, right? First one we talked about, right? Forecasting earnings is notoriously difficult, right? We saw last week that people are really bad at forecasting the future, right? Experts are really bad, right? Most sell-side analysts, think about themselves as experts. We have to pick a discount rate, right? Well, what's the discount rate we should pick? Should we use a rate like treasury bonds? Well, maybe that seems a little bit low, especially during periods of time where maybe you have a lot of Federal Reserve quantitative easing and things like that, and interest rates are maybe abnormally low, so maybe that's not a great discount rate to use. Should we use historical equity returns? Maybe, right? But there's no reason to think that the high returns or the 9, 10, 11% returns of the past necessarily have to repeat themselves, right? Should we use a different discount rate based on the riskiness of a particular investment, right? Maybe you have some company that doesn't have any earnings today, or is very speculative. Maybe you should use a higher discount rate for that company. And maybe you have Procter and Gamble, which is an old stable company. Maybe you should have a lower discount rate for that company. But if that's the case, how do you decide how risky something is? Basically, all I'm trying to say is that kind of trying to forecast the correct discount rate to use is very tricky. Next, right, the bulk of the calculation sits in the terminal value. So like I said, most analysts who do a discounted cash flow will forecast out earnings for, let's say, the next 3 years, and then we'll put the terminal value, right? The terminal value you can just basically think of as what they think they could sell the asset for in the future, in 3 years from now, right? Well, that's kind of a little bit of a circular argument, right? Because how do you know what you could sell it for in the future without knowing things like what the earnings are going to be at that point, how they're going to be growing, things like that. Most people, most investors kind of just make some assumptions on multiples, which we'll talk about in a minute, apply that multiple to that terminal year earnings. But it seems a little bit not intellectually rigorous. There's other problems, right? DCFs are time-consuming labors, right? Like it takes a lot of time. If you're going to do a real DCF, if you're going to really think about what do I think this company is going to do, in terms of revenue or earnings next year, then I have to think what's going to do the year after, then the year after that. You're going to spend a lot of time. Now, maybe that's time well spent, but again, if you kind of believe my earlier premises that most of the time the market does a pretty good job, and it's only when they make glaring mistakes, you're going to probably be spending a lot of time analyzing companies and just coming to the conclusion that they all seem reasonably priced, and you're going to be spending a lot of time and not getting much return on that time. And then lastly, there is what I call the Hubble telescope problem. So the Hubble telescope problem is just simply that small changes in your input will lead you to completely different changes in the output. So, you move the Hubble telescope, a little bit one way or the other, and all of a sudden you're in one galaxy and then you're in another galaxy. So small adjustments to things like discount rates or growth rates or earnings estimates can lead to pretty significant differences in value. Now, the other way that most people look at value is they just use valuation multiples, right? Unfortunately, these have their own drawbacks, right? First of all, which multiple to use, right? So there's many multiples, right? There's PE multiple, which is probably the most popular, the most common, the price to earnings multiple. But there's also things like EV to EBITDA, enterprise value to EBITDA, right? Maybe that's the right multiple that we should be looking at. Some companies, maybe they're not profitable. They look at things like EV to sales, right? So which multiple should you choose, right? Then there's a question of, should you use trailing numbers? Should you use forward estimates? You can make your choice on that. What if current earnings are maybe depressed, right? What if they're, overstated, right? Company might be under earning, company might be over earning. That could be very distortive to the multiples. So maybe the multiples aren't going to be that useful. And then even if you think the multiples are useful, right? Like, what does it mean, right? Should you compare them to historical multiples, right? Are historical multiples even comparable, right? If I look at a company that trades at 20 times earnings today and it traded at 15 times earnings, 10 years ago or 15 years ago or 20 years ago, right? Is that valid? Can I say that that company is expensive now? Maybe that company is growing faster, right? Or maybe interest rates are lower today than they were 20 years ago. So, how can you really make sense of multiples, right? What's interesting is, multiples, when you really kind of break them down, and again, it's not something that, we really need to talk about right now, but when you break them down, are really just shortcuts for discounted cash flows. So, and again, like we said, discounted cash flows themselves have their own shortcomings, and then multiples, I think you're just adding more shortcomings onto that. So, thankfully, there is another way. Gordon Growth to the rescue. Now, what do I mean? Well, so this, if you remember from 3 slides ago, was the equation for discounted cash flow. Okay, well, that's not very useful to use. Now, we can kind of tweak it a little bit, and we can write the equation this way. So we can say, E naught, E0 is really just whatever the earnings are today. And then all the future earnings are a function of some constant growth rate. over from now until the end of time, and again discounted by that appropriate interest rate from now until the end of time. Well, this isn't a simpler formula, right? All we've added is an additional term, growth, and I don't think we've really helped it. This is not going to make your job any easier, right? Well, we can go even one step further, right? So we could take this equation, but the beauty of this equation is it actually simplifies to this. This is the Gordon growth equation. So price is really earnings divided by R, the discount rate, minus G, the perpetual growth rate. Now we'll talk more about what those mean in a minute, but I think now we're starting to maybe make a little bit of advance. But again, how useful is even this Gordon growth equation at the bottom? I think still remains to be seen. But we can even go one step further. We can take that Gordon growth equation and we can rearrange it. And so if we rearrange the Gordon growth equation, what we see is that R, the discount rate, or the required return, the return is really a function of E over P, the earnings yield. So think of it as the inverse of the PE ratio, PE multiple, plus some term G, which is the perpetual growth rate. So I think now we may have something where we can start to see some benefits, right? So here we get some benefits, right? One, when we use this Gordon growth equation rearranged, right, when we don't need to explicitly forecast future earnings, right? Two, we don't need to pick a discount rate or the required return, right? We can actually compute the implied discount rate from the equation if we know the other two variables, right? We don't have the terminal value problem, so we don't have to guess the terminal value, right? So all of a sudden, it's much less laborious than trying to even do a simple DCF. And like I said, the required return or the implied return can be an output of the earnings yield and a growth rate assumption, right? And so let's see how this becomes a lot more powerful as a way to analyze intrinsic value. So right off the bat, what we can see is that the return is really composed of two different parts. One is what I call the safer earnings yield, right? That's what today is, right? The earnings yield. And then the second component is maybe the more riskier, less certain growth component, right? Now, the growth component can't be too high, right? And why can't it be too high? Well, this is a perpetual growth rate, right? So it's the growth rate of this company from now until the end of time, right? So if you just think about it, right, a company can't grow its earnings into perpetuity really faster than GDP, right? Because if it were to grow faster than GDP into perpetuity, it would stop being a company, it would start becoming the economy, right? We'll talk about this next week in a lot more detail. The other thing that it does, which I like, is it forces us to really consider the durability of the business, right? So can we, at least as far as we know, right, will this business be around, for a long, long time? Now, obviously that could change down the road, but as of now, we'd look at it and we'd say like, okay, is this business durable? Is it not durable, right? A business that is not durable, or you have questions about its long-term durability, has a perpetual growth rate of negative 100%, right? It's going to zero. So, it will hopefully, at least force you to kind of think about things like the durability, not just what's happening in the near term, but the long-term durability of the business. And then the last reason why I really like this approach is it makes asset class comparisons a lot easier. So we can look at stocks, we can look at bonds, we can look at real estate. And when we put them through this Gordon growth lens, the comparisons become a lot easier. And so imagining things like the return in stocks versus the return in bonds, or the return in bonds versus the returns in real estate, it becomes a lot easier to kind of frame it in your mind. And we'll talk about that in a few slides, right? The other thing that's important, right, is you don't need precision, right? And I think the best way is just to quote what Buffett himself has said, right? It's like if somebody walked in the door and they weighed between 300 and 350 pounds, right? I might not know exactly how much they weigh, but I would know they were fat, right? That's what I'm looking for, is something that's financially fat, right? So what I'm looking for is I'm looking for something that has an almost, inarguably high implied rate of return, right? And the discount rate, the implied discount rate is very high. Now, we talked about this with Peter Lynch a couple of classes ago, right? Peter Lynch made this rule about when to buy bonds, right? He said buy bonds when the treasury yield was greater than the dividend yield plus 6%, right? And so we talked about this a little bit, and I kind of deferred to this class as to why he came up with that rule, right? But basically what he's doing here is, as you could see, is he's basically, instead of an earnings yield, he's using a dividend yield. Instead of maybe like a GDP-like growth rate, he's using a little bit higher growth rate. But he's coming to the same point, right? He's basically estimating the equity returns as basically a dividend yield plus 6% growth, right? And so, his whole point is basically you want to buy bonds when they offer a higher return than stocks, right? And that's what he says, if you read any of his readings, that when he bought bonds in the early 80s, the whole reason he bought bonds was because he thought the returns were going to be higher than stocks. Now, what's funny is that for all Buffett's talk about discounted cash flow being the way to calculate intrinsic value, he does not use discounted cash flow, right? He's actually said explicitly he doesn't use discounted cash flow, but importantly, he hasn't said explicitly what he uses, right? Charlie Munger, his longtime partner, had this to say at one of the Berkshire annual meetings. He said, "We have such a fingers and toes style around here. Warren often talks about these discounted cash flows, but I've never seen him do." So really what I think, and again, I will hopefully prove this to you in more detail next week, but what I think is Buffett's reasoned rule, right? We talked about reasoned rules, right? Simplicity, simple algorithms outperforming sort of complex analysis by experts, right? And so, I think Buffett has dropped enough clues, enough breadcrumbs that we can deduce his reasoned rule. And his reasoned rule is really two. It's invest when, one, the earnings yield alone provides you an acceptable return, and two, the business is almost certain to grow in the future, right? So as long as the business doesn't decline, right, at the very minimum, Buffett is guaranteed an acceptable return, right? The G, as long as the business doesn't decline, and at least if you can hold it stable, G is 0, right? So return equals just the earnings yield. And if the business grows, which is very likely, then his return will be something more than acceptable. So what's important here, and this is, we've talked about like how do you forecast and things like that, is in this case, when you think about a rule like this, the power of the rule is you don't need to specifically forecast the future, right? You just need to answer a couple of yes/no questions, right? Yes or no, do you think that the business will likely have higher earnings in the future, right? It's in some ways it's like answering the question of like, here we are sitting at the end of October. Do I think that it's going to be warmer next July than it is today, right? That's in many ways, an easier question to answer than do I know exactly, what, what's the temperature going to be next July or next August or something like that. Like I said before, the reason, Buffett focuses on things like a moat is really to understand the durability of the business, right? Because any company without a moat, effectively will go to 0, and therefore the perpetual growth rate is, like I said, negative 100%. And so therefore, the return is actually, the long-term implied return is actually pretty low. So one of the readings next week is going to be excerpts from the Berkshire Hathaway letters. And so as you kind of look through that, I hope, by reading it, you'll see how, you'll see kind of how Buffett has applied this heuristic without him coming out and explicitly saying this is his heuristic. Now, we can also piece it together a couple of different ways, right? Or at least one other way. So Todd Combs, said this about Buffett. First of all, who's Todd Combs, right? So Todd Combs, along with Ted Weschler, are the two portfolio managers who Berkshire Hathaway hired, to basically start managing a portion of the investment portfolio. And then once Buffett, leaves or steps down or passes away, their responsibility is going to be to take over the investment portfolio. And so Todd Combs was at a lunch that Columbia University hosted to honor Benjamin Graham, and he said this, and it was asked in the comment of like, how did you guys find Apple at the time, right? When they invested in Apple, and he said, Warren asked, how many names in the S&P are going to be 15 times earnings in the next 12 months? And then he asked the question, how many are going to earn more in 5 years using a 90% confidence interval? And how many will compound at 7% using a 50% confidence interval? Okay, well, let's see what we can kind of deduce from this, right? So if we put this into the Gordon growth formula, right? This is the Gordon growth formula, R equals E over P, the earnings yield plus growth. So he said, which companies are going to be at 15 times earnings or less? So 1 over 15, the inverse of the PE ratio. And then he says, a 90% confidence that earnings will be higher and 50% confidence that they'll compound at least 7%, right? So think of it as, 0.9 times 0.5 times 7%, right? Well, that really boils down to, the earnings yield of 6.7% plus an expected, kind of growth rate of around 3.2%, which kind of, with a little bit of rounding gets you right to a nice 10%, right? So really kind of which companies are going to give you at least a 7% return, and with a little bit of growth, kind of like GDP-like growth, get you closer to 10%. Now, some of you guys may take away from this, which I don't want you to take away, that what I'm just telling you to do is just buy high earnings yields or buy low PE multiples, right? That's not the case, right? Most companies trade at high earnings yields or low PE multiples because there's significant doubts about the long-term sustainability of the business. So you could look at, General Motors, you could look at Ford, you could look at Target. Those are examples of companies that historically have pretty low PE multiples. And I would argue that one of the reasons why they have low multiples is because there's real questions about the long-term sustainability of those businesses. And two, current earnings may not be representative of normal earnings. So when companies are in very unique positions where maybe they're in a cyclical upswing, cyclical businesses at the very peak always look like they have low PE multiples or look like they have high earnings yields. But that's because the market knows that those earnings are not sustainable, right? So when oil goes to $200, you'll see, ExxonMobil trading at 4 times earnings or 3 times earnings or something like that, because the market knows that those earnings can't be sustained. So don't just go out and just say that I'm just going to buy low PE multiples, and that's going to be how I'm going to make money, because it's a little bit more complicated than that. You really have to find the ones that are improperly trading at low PE multiples or high earnings yields. Now, the other point that I think is important is intrinsic value is kind of personal, right? And the way you can think about it is an investment is a low intrinsic value if it offers a high return, right? Well, what does a high return mean, right? A high return can be different things to different people, right? Now, I do think that one way it's helpful to frame it is in the context of things like bond yields and historical equity returns, right? So if you look historically, equity returns have been around 9 to 11%. So if you see something that you can reasonably think that the implied return is something higher than that, you could argue that that might be below intrinsic value, right? If you look at it today, if you use Peter Lynch's rule, right, of a dividend yield plus 6%, well, today the dividend yield is 1%. You add in 6%, you would be around 7%. So maybe Peter Lynch would say equity returns are around 7%. if you take today's earnings yield for the S&P 500, which is, the multiple is 25, so the earnings yield's around 4%, and you take a kind of a 4% GDP growth rate, that would kind of get you to around 8%. So, basically you could say like, well, you don't necessarily need to know exactly, but, probably if you were guessing today, equity returns, long-term equity returns are probably in the high single digit range, right? Maybe 7%, 8%, 9%, 10%, something in that range. Now, what's important is, well, we can at least, and what I said before, one of the benefits of this is it makes cross asset comparisons a lot easier. So, today, the 30-year Treasury bond is right around 4.5%. So if you don't want to invest in stocks for the long term, you can buy treasuries. Instead of making maybe 7%, you might make 4.5% if you buy a treasury bond. You could buy an investment grade bond. If you bought an investment grade bond today, you'd make about 5.5%. You could buy a junk bond, and maybe if you bought a junk bond, you'd make about 6.5% today. So it's at least a way to kind of think about how equities stack up to other asset classes, how they compare to their own historical returns, and things like that. But like I said, in the end, intrinsic value is personal, right? In the sense of if you are computing or imputing what the implied return is, somebody might say that implied return is really high, in which case the intrinsic value, in which case the price is below intrinsic value. Some other person might say, well, I've got tons of great investment opportunities. I think that intrinsic, that implied return is kind of low, in which case for them, the price would be too high relative to their assessment of intrinsic value. So this is where, I think it's just very important to kind of understand that, two people, don't necessarily come up with the same numbers for intrinsic value. And that depends on what your personal sort of hurdle rate or opportunity cost or something like that is. Like I said, if you can kind of roughly estimate what the implied return of equities are, or the implied return from bonds are, you can at least kind of calculate what your opportunity cost is, assuming you don't have, some AI startup that you're a founder of or something like that, and use that as a way to kind of impute where different things are trading. If any of this is not clear, like I said, I'm going to answer questions at the end. So again, going back to what we've talked about before, right? Investment versus speculation, right? Investment is buying for keeps. Speculation is buying with the intent to sell to others at a higher price. You can buy a low return if you think yields are going lower, right? So think about a trader who buys a treasury bond at 4%, right? And that trader probably doesn't plan to hold that bond to maturity to make 4%, right? They're buying it really because they think that interest rates are going to go to 3% or 2% or something like that, in which case they'll be able to turn around and sell the bond at a profit, right? Or think of it alternatively, right? You buy a stock at 30 times earnings, 33 times earnings, right? At 3% yield, you will still make money if you're right and it goes up to, let's say, 50 times earnings, right? At 2% yield, right? But you may not make a good return if you're just holding that investment, right? So, think about it as this is the core difference between investment and speculation. Not saying that speculation is necessarily wrong. I just think that it's harder to have a successful, repeatable process. So don't confuse investment and speculation. So anyways, I hope that that's been somewhat informative. I'm sure there's some questions. Like I said, I'll talk about that. But really, what I want to do is now just turn over to margin of safety, which is the other component. The reading was really, chapter 20 of The Intelligent Investor. Benjamin Graham, again, we've talked about him before, the father of value investing. Buffett's teacher at Columbia Business School. He wrote Security Analysis and The Intelligent Investor, and he managed Graham Newman Corporation, which arguably was the first hedge fund, right? So chapter 20, margin of safety as the central concept of investment, right? Well, why do we want a margin of safety, right? It's because we're uncertain about the future, right? We might be uncertain about earnings, we might be a certain amount of discount rates, interest rates, things like that we've talked about. But really what it is we want to protect ourselves against any mistakes we make handicapping intrinsic value, right? So we just thought about intrinsic values, kept computing what the implied return is for, you know, an investment, and then making a judgment is it below or above intrinsic value. And we want to protect against, you know, some mistakes that we might make. You know, we might be completely wrong on where we think interest rates or, you know, equity returns are in the future, and so we like to build in a little bit of a buffer, right? So, but how big of a discount is a margin of safety, right? It's a very, you know, when most people talk about margin of safety, they're talking about it as a very amorphous concept, right? Buying it at a discount to intrinsic value. You know, a little bit circular in some ways. Well, Benjamin Graham had a kind of a precise definition of when a margin of safety exists, right? He said that you get, you know, margin of safety exists when the earnings yield is greater than bond yields, right? So you get the safety of a bond while retaining the upside of an equity. And, you know, when you think about it, like an earnings yield greater than a bond yield, well, the first term in the Gordon growth equation is the earnings yield. So it kind of fits nicely with that equation, or that way of thinking at least. And, you know, this is what Graham had to say, right? In common stocks, the margin of safety lies in an expected earnings power considerably above the going rate for bonds, right? Now, why did he pick this? It's kind of a weird, you know, maybe not a naturally intuitive way to think about it, right? Well, there's a corporate finance perspective that we can think about, right? And he says there are instances where common stock may be considered sound, and this will occur when a company is selling for less than the amount of bonds that can be safely issued against its property and earnings power. So let's do a quick thought experiment, right? So imagine a company, it's earning $10 million, it doesn't have any debt today, it's trading at a value of $100 million, and interest rates are 5%, right? Well, what could this company do, right? They could issue $100 million of bonds, right, which at a 5% interest rate would cost them $5 million of annual interest, and pay it out to shareholders, right? Now, those shareholders will recoup 100% of their investment and still have $5 million of earnings left over, right? The 10 million of earnings they had before, less the 5 million of earnings that they're now paying for interest, leaves you $5 million of earnings, right? And if that $5 million of earnings is left over, right, or is valued kind of the same, you know, might be valued at, you know, perhaps $50 million. So, you know, and the benefit of it is like shareholders would still benefit from any growth of that business in the future, right? So in Graham's mind, he would say that that's a very safe investment. It's almost impossible to really lose money. And you know, in the chapter, he actually uses an example. He talks about this company, National Presto, right? So National Presto sold for an enterprise value of 43 million, and it says with 16 million of earnings, the company could easily have supported that amount of bonds, right? So $16 million of earnings divided by a $43 million value is a 37% earnings yield, right? Now, in 1972, when this was written, treasuries yielded around 6%. So I would imagine a corporate bond rate was probably around 7 to 8%. So let's assume 8%. So you could have borrowed $43 million of debt at 8% interest. It would cost you about $3.4 million a year. And the shareholders would have recouped 100% of the value, the market value of the stock, and still have about $12.5 million of earnings after interest left over for them, right? So this is, you know, this is in some ways how, you know, one way to think about, you know, margin of safety. Now, he also makes a couple of other interesting points, which I think are worth kind of mentioning. You know, his point is it's riskier buying low quality when times are good. So what's interesting is that Benjamin Graham, even though most people, when you read about Benjamin Graham, you think about him as like a deep value cigar butt type investor, but he really recognized the value of quality. And he said that the risk of paying too high a price for good quality stocks is not the chief hazard confronting the average buyer, right? And he says, observation over many years has taught us that the chief losses come from the purchase of low quality securities at times of favorable business conditions, right? And so, and then he goes on and says the purchaser views the current good earnings as earnings power and assumes that prosperity is synonymous with safety, right? And so basically what Graham is doing is echoing Keynes, right? Investors tend to extrapolate the current conditions. They assume that these good conditions are going to exist indefinitely, right? And so what he's saying is that, you have to be very careful to make sure that, these current good conditions, that the business isn't necessarily over earning, because then you'll end up in a bad business and then the earnings will go down and, you'll lose money. And he says that's probably the chief risk. So timing is just about right. So let's just get to the conclusions, right? So intrinsic value is the price of an asset if you would never sell it. Liquidity, again, can cause potentially large gaps in market price and intrinsic value. Price is meaningless as an indicator of intrinsic value. DCF is the intellectually correct way to calculate intrinsic value, but has many shortcomings. So I think the Gordon growth equation is an easier way to gauge whether something is trading at, above, or below intrinsic value. And margin of safety exists when you can buy a stock at a bond equivalent like price. So next week's class is going to focus on Buffett. We're going to see how the Gordon growth can be applied to various types of investments. We're not just going to look at equities. We're also going to look at bonds, preferred stock, real estate. But we're also going to understand how it can be used to evaluate asset classes and what Buffett has said in general. So the readings next week are one, excerpts from the Berkshire Hathaway shareholder letters. You can find the full letters on the website. What I did is I just took portions of each of the letters or most of the letters, and I put them into one document so you can at least streamline it. There's an article called A Warm Tip from Warren Buffett. It's time to buy Freddie Mac. So he wrote that back in, I'll say 1988. He wrote an article for Forbes called You Pay a Very High Price in the Stock Market for a Cheery Consensus. That was from Forbes magazine back in 1979. And then in 1999, he wrote an article in Fortune magazine called Mr. Buffett on the Stock Market. So, I think hopefully you'll find all of these very practical and very informative. So with that, we are done for the lecture portion of today. I'm going to stop the share, and I see a question already, and hopefully you guys have a lot more, and we'll hopefully get all the questions done in time. Charles, you had a question at the very beginning, so I'm going to start with that. Do you want to repeat the question and then I'll repeat it again?
Yeah, this is regarding to when to sell, because today you kind of answered the question about when to buy, right? If you have an intrinsic value, you have margin of safety, that's the time you should buy the stock. But then it's always talking about you should hold the stock forever. And now my question is when to sell, right? Basically is if you have a stock, you have dividend. Basically, you earn the dividend, you can hold for quite long, you earn the income. But if your stock doesn't even have a dividend, you cannot hold forever, right? Because you don't earn anything. It's not like a house you can live in it. But a stock is just a paper. If you don't sell it, you don't get anything from it. So my question is that when you sell, what's the time to sell? Yeah.
Okay, so let me kind of maybe let me talk about this a little bit. So really, I think there was two questions, right? One, at the beginning, you asked a question about what about companies that don't pay dividends, right? You don't get anything from the company, right? And that's true, right? A lot of companies don't pay dividends, right? But the assumption is, right, that either now or in the future, they could pay dividends, right? And that will be the value that you get, right? The other point is that if a company is retaining its earnings, let's say it earns $1 and it doesn't pay you a single cent of a dividend, it takes all that money and it retains it, right? But if it's retaining that money and investing it and earning a good return on that money, right? You know, the assumption is that maybe not tomorrow, right? Maybe not even in the near term, but at some point the market will give you value for those retained earnings, right? You know, Buffett uses a rule, which he says, you know, we look for, you know, the company to create at least $1 of value for every dollar it's retained, right? So what he's basically saying is, you know, create $1 of market value over 5 years, right, for every dollar of earnings that have been retained. And so what he's basically saying is, if you were going to retain the money, you know, you may not recognize, you know, the market may not recognize all the value today, but as long as you're earning an acceptable return on that retained earnings, right, the market should recognize that value over time. And if, you know, if for whatever reason it doesn't, you know, that's, that might be, that might be something to kind of think about. But, you know, I think usually over enough period of time, right, the market will tend to realize the value of the retained earnings, as long as those retained earnings are generating an acceptable return, right? If a company's return is, let's say, only 4 or 5%, and, you know, the stock market is returning 8 or 9%, right, then, you know, the company should not be retaining earnings, right? But as long as the company's earning a reasonable return, you know, the assumption is that as they retain more and more earnings, they should be able to realize value over some period of time. And so it really goes back to, you know, your point about companies that don't pay dividends, right? But companies, you know, lots of companies don't pay dividends, or lots of companies today pay very, very small dividends, right? Like you look at all these big tech companies, they pay very small dividends, right? But at least part of the reason why they have value is because people think that their ability to retain earnings and invest those earnings and build, you know, data centers or whatever that they're doing with that capital today is going to lead to, you know, higher earnings in the future.
Yeah, I understand that the concept basically says they retain an earning, they can generate more return than the owner or the stockholder get a cash, right?
Yeah,
the return will be higher than what you own. That's their assumption. That's why they keep it. But then come to the next question would be, they always say you don't sell, you should hold forever. Even Warren Buffett says he's holding the Coca-Cola forever. But it's just a paper money, right? I mean, you're gonna get the return somehow, some way. You cannot just say, okay, I'm gonna hold it forever. And what's the point, right?
well, let me put it to you this way, okay? I think that let's say a company keeps retaining earnings and the stock doesn't go up, right? Well, one of two things could potentially happen, right? One is they themselves could start buying back their stock, right? In which case they're shrinking the share count, you know, potentially a lot, which should, you know, even if the value of the business doesn't go up, the per share value of the business should go up from that. And then two, you know, if the value doesn't get recognized, right, like you will have, you know, you have other strategic buyers who will say like, okay, I can buy this business at a very attractive price. You have activist investors, so, you know, Carl Icahn or Bill Ackman or one of these guys will come and, you know, say like, oh, you know, force you to sell or try to get you to sell or something like that. You know, you might have some, you know, some private equity company come in and try to buy you. So there are mechanisms to, you know, the beauty of the market, especially here in the United States, is the capital markets, is there are mechanisms to, you know, to close, you know, to kind of arbitrage value, right? And so, you know, that is it. Listen, it's always a little bit of a question of like, will you ever recognize the value? Or, you know, does the market always kind of stay the way it is? But, you know, the markets, the funny thing is markets are very competitive, right? And so people are always looking to find uncovered value. If you're right, and if other people, you know, agree with you and you're right, other investors will come in and buy it, right? Or
I understand that the approach is more like the value eventually will be recognized. Some way you can get your return. Yeah. But let's say the value is recognized, like NVIDIA, right? If you purchased 5 years before, it's keep increasing. then at which point you should sell it or you just hold it forever? That's my second question, right?
Sure. So the question that Charles is asking is, at what point, let's say you bought a stock, it's gone up, and at what point should you sell it, right?
Yeah.
Well, so really what I said is what I think is, at that point, what you should do, and again, there's a tax concept, tax concept that you have to think about too, right? But you have to think about what if you sell it, what are you going to do, right? What's your use of capital, right?
Mm-hmm.
If you're going to sell it just because you don't have any other good returns to put it in, right? What's the use of selling it, even if it's making a low return, right? If you see some great new company that has a really high return, right? Even if you think your company has a high return, but this company has an even higher return, right? It arguably might still be logical to sell it, right? Or let's say the returns go so low that it's smarter for you to take the money and put it into bonds because you're going to make a higher return at that point. So really, it just comes back down to the question of, what is your opportunity cost, right? What else can you see out there that you can generate a higher return? And if you can see something that you can generate a higher return, then you should sell, right? Doesn't mean that just because the return is 10%, you should buy or sell, or 5% you should buy or sell. It's really just comes down to, what are you going to do with the money, right?
I agree. Yeah. The other one is the last one is that when I read paper correctly, it says if you're under the intrinsic value, you buy it. If it's higher than the intrinsic value, you sell it. But that's probably not the case, right? Because if you even
again, I think I like this other concept of, instead of thinking about intrinsic value, really kind of try to think about what's the implied return, right? And it goes back to the question of, look, if your implied return goes lower, right, meaning the stock has gone up, intrinsic value is a very ephemeral concept. But if it's gone up and the return is lower, but the return on everything is lower, right? Again, why would you sell it? Because what are you going to put it in that's going to have a better return, right? Does that make sense?
Makes sense. Yeah. I like this implied return. Yeah, makes sense. The one more is a.
Hey, Charles, can you just get back in the line? I just want to make sure other people have time to ask questions.
Go ahead.
MD, I think you were next.
Hi, Jay. You mentioned about the moat, which will indicate the durability of the earning power. How do you know that the business has a moat?
Well, first of all, there's lots of books that you could, people have written about this a lot, right? But the quantitative way you look for a moat is a business that has generated and sustained a high return on capital, right? So when you think about, what does that mean? It means the capital is basically the money you needed to put into the business to start the business, right? Or be wherever you are, right? So Google today has invested capital of, I think, roughly $30 billion, right? So, it's taken $30 billion of actual kind of capital to, build their data centers, their servers, their whatever, their offices. But on that, they generate a really high return, right? And so if a business had no moat, right, $30 billion might seem like a lot of money, right? But that's a tenth of the cash position of Google or whoever, of Berkshire Hathaway or whoever, right? And so if all it took is money, somebody else would, make that same investment and try to compete with Google or something like that, right? As an example. So the point being is that companies that can generate high returns on capital and sustainably high returns on capital, right? Basically, they show you that they have a moat, right? Because what they do is other people, even with money, can't replicate what they have, right? So, again, you've heard these probably things in the past, right? That even if you gave me $100 billion and told me to go compete with Coca-Cola or whatever, right, I wouldn't be able to put a dent into them, right? Because it tells you that just money alone won't help you kind of succeed in the business, right? Whereas other companies, if you had enough money, you could probably compete with these businesses successfully. Now, there's a qualitative way to think about moats too, right? Which is, what is the source of the moat, right? Is it intellectual capital? Is it intangible assets? Is it brand value? Do they have access to a low-cost resource? Is there some sort of customer switching cost, right? Things like that. So that all gets back to just kind of competitive strategy and network effects, right? If you're, let's say Meta or eBay or something like that. So those are all kind of the qualitative ways of an economic moat, but the quantitative way to see if there's a real economic moat in the business is to see if the business can generate abnormally high returns on capital and have not gotten competed away even after many, many years.
So what's the percentage of the return on capital invested do you think that is considered as a moat?
I mean, look, I look at it like this. If you think about equity returns as, let's just say, use rough numbers, 10%, right? I think if a business can sustainably do something better than that, like 15%, 20%, 25%, I mean, you see companies doing, 80, 90, 100% returns on invested capital. I think that's a good indicator that the business has at least some level of a competitive advantage.
How do you know that it is sustainable?
Well, you don't know. You could look at history, right? History is first a good indicator, right? So if a company generated a 20% return, but only for 1 year, I wouldn't necessarily believe in that. But if I see a company's generated, let's say a 20% return on capital for 10 years or 15 years, right? That would at least help you kind of have more confidence that that return is sustainable. And then again, this is part of the exercise of understanding what is the source of the competitive advantage, and then understanding what's happening in the business and the industry to see if you think it's sustainable or maybe even getting better in the future.
Thank you. I'll come later because I have other questions, but different.
Sure. Okay, great. David.
Hey, thanks. So for this Gordon growth formula, so the companies that are considered cyclicals, I guess like airlines and autos and chemicals, we can't really use this, correct?
No, you can. The only difference is that you, instead of using the current earnings, use a normalized earning, right? So think about maybe take their best, look over whatever a cycle is, 5 years, 10 years, whatever the number is, and maybe think about what's their best year of earnings and what's their worst year of earnings, and maybe kind of average it out or look at the average earnings over 10 years or something like that. But no, you can definitely use it and kind of think about what's normalized, the earning, what Graham was saying, right, is instead of capitalizing, earnings during a good time, take the normal earnings, right? Or the average earnings or something to that effect.
Okay. And for something like an oil company where I guess your profits are dependent upon the price of oil, is this something you can use for those companies as well, or not really?
Yeah, I mean, again, I think you can. Again, oil prices, might fluctuate within a wide band, but usually when oil prices are high, the cost of oil production is also high. And when oil prices are low, the cost of production also goes lower. So the margins, the dollars per barrel of production vary less than the prices do. The profit per barrel varies less. But again, you might have to look at kind of a range and then kind of try to estimate where you think, what do you think is normal within that range?
Yeah, thanks.
Sure. Suraj?
Yeah, my question is more around how do you apply this Gordon growth model to the company where there is no profitability? So like zero earning or something like that. And the second question is suppose it seems like it's more inclined to it's giving more weightage to growth. So basically even if the P ratio is very high, like 200, So the first component, earning yield, might become like very small or become close to zero. But if the company is growing at like 20%, 25%, then return would be close to 20, 25%.
Okay, so the first question is, I'm just going to repeat it so everyone could hear it. The first question, and just to make sure I got it correct too, right, is how do you use this to value companies that don't have any earnings, right? And it's similar to David's question, right, about cyclical companies. But if a company doesn't have earnings today, again, you have to kind of think about, well, what could it earn? What could it be earning today, or what could it be earning to, in the near future, right? Like there are companies today that are purposefully not having any earnings, right? Not because that they don't want to, or that they don't actually have earnings, but they're actually investing and maybe over investing. So the great example is Amazon, right? Amazon, people said like, oh my gosh, this business really doesn't make any money or whatever. But when you really look at those businesses, you'd say, well, actually, we know what, like, we could look at like a Walmart or something like that, and we could say like, okay, this is what the retail business is like. And then we could see like what, AWS, what a software, cloud business can be profitable and this and that. And, they have an ad business and this and that. And, you can make reasonable guesses as to what the earnings are. And then in the case of somebody like Amazon, right, because they're investing so much, but their investments are all kind of in the income statement and effectively masking the true earnings, like you have to kind of do the work a little bit to unmask what you think the true earnings power is of the business, and then use that as kind of your quote unquote normalized earnings, right? So that's how you do that. And then your second question is, well, you have these companies that may be trading at really high PE multiples, so really low earnings yields, but they have really high growth, right? And so the flaw in that is the fact that at least when you use the Gordon growth kind of model for intrinsic value, right? That G function, the growth, is not growth over 1 year, 2 years, 3 years. It's perpetual growth. It's a perpetual growth rate. And so that's why I was saying is like, you have to be very careful because, companies might be growing very fast today, but, they can't maintain a perpetual growth rate higher than whatever you think, just overall economic growth is, right? Because no company can grow 20% forever and have an economy that's only growing at 4% forever. Because like I said, at some point they would become, and surpass being the economy, right? And so unless you think that the company is going to become the economy in general, even if it becomes the economy in general, it can only grow at whatever the economy itself is growing at. So this is where, the right way to think about it, in my opinion, right? The right way to really think about it is when you see companies trading at very high multiples, very low implied yields. What that really means is that investors are asking for a lower return, right? A lower required return, right? So in your case, a company trades at 200 times earnings, or let's say a 0.5% earnings yield, and let's say a perpetual growth rate, let's just use as 5%, right? Just for round numbers. Effectively saying that people are buying that stock accepting 5.5% long-term returns, right? Now they might be accepting 5.5% long-term returns because they think that that's an acceptable return, or they might be accepting 5.5% long-term returns because they really think that they can sell it to somebody else at an even higher price or an even lower return, right? That's what I was saying with the concept of like, if you think about a treasury trader buying a bond at 4%, right? He's not really buying the bond thinking he's going to hold it for 10 years, 20 years, 30 years and making 4%. He's really thinking, I'm going to buy it today because I think interest rates are going to fall in the near term and I'm going to turn around and sell it to somebody else. So when you think about it now, you might call that speculation. I would call it speculation, but that's really what it comes down to. Is it's more like low implied returns probably means something more like it's trading at the speculative end of a bubble price versus the intrinsic value price, if that makes sense.
Yeah, I think that makes sense. But how do you think about this perpetual time period? Like, Should it be 5 year, 10 year, 20 years? Like if you think about like too
I
long,
mean,
you can almost
conceptually, perpetual is forever, right?
yeah.
You know, that's where, you know, again, and the reason why a perpetual growth rate is actually useful to you is, you know, if you're just thinking about 5 years or even 10 years, right? You know, over that period of time, you know, a company might grow at a very high rate, right? But the perpetual part of the growth rate really helps you to cap, you know, or to kind of think about like limits on what the growth rate could look like. And so that's where it becomes more useful than just thinking about it over a shorter time frame. Christina, I see your hand went up.
Hi, Jay. My question is there some limitations with the Gordon growth model? In particular, it seems like it's not the best suited model for evaluating tech companies, where by definition, the growth rate is not going to be perpetual because there are waves of technology that wipes up everything, like AI is wiping out a lot of different companies. So it's impossible to assume that the earnings will be perpetual, the growth rate will be perpetual. And therefore, first of all, is it not a good way of using that model to evaluate high-tech companies? And secondly, is that the reason why this is not what tech companies is typically not what Buffett invests in?
Yes, I mean, you kind of answered your own question, right? So to use this model, right, you really need, like I said, you really need to think about, okay, sorry, let me just repeat the question so everyone heard it, right? So what Christina was asking is Gordon growth, as we were talking about it, earnings yield plus growth, but the growth is a perpetual growth rate. And the problem with technology is technology comes in these waves, and you know, companies, you know, become obsolete. And so those companies don't have perpetual growth, right? And the answer is that's absolutely yes, right? Like, and that's one of the reasons why, you know, Buffett has said, look, we don't invest in tech. Now, obviously, he invested in IBM and then he invested in Apple. And so I'll talk about that at some point. But, you know, when you look at Apple, he really viewed it more as a consumer company than a tech company. And he said, look, they've developed such a consumer franchise, and that even if somebody invented a more technologically advanced phone, or you know, you talk to people who have a Samsung today, and a Samsung phone they'll argue is, you know, 2 generations already advanced more than an iPhone might be, or have features, you know, in advance, and people still stick to the iPhone, right? And his argument is that it's because they've built a consumer franchise more than, you know, they're not competing on technological innovation. But yes, that's right, and that's the problem with investing in tech. It's also, you know, going back to, I think David asked at the beginning, right? One of the optional readings from last week was that article about Cisco, right? And Cisco in the 80s, or in the late 90s, early 2000s, was considered to be like one of these great companies. But you know, again, the world changed, and you know, things like that happened, and you know, and Cisco is just one example. There's, you know, countless examples of this. So, you know, that's where one of the things that I think a lot of people would argue is, why is it important to focus on the durability of the companies, not just the near-term growth, in terms of thinking about the implied long-term returns? And again, for a lot of companies, if you can't answer the question of, you know, do you believe in the durability of the growth, you can't answer the question of what's the intrinsic value, right? Because if the growth is durable, it might have one value, and if the business, you know, is going to go away even in, you know, 10, 20, 30, 40, 50 years, you know, it might have a much lower, significantly lower intrinsic value. Okay, let me get back to, because I know we're over time already. Man, time flies. Charles, why don't you ask one question, and then MD, why don't you ask one question?
All right. So regarding to discount cash flow, so the golden growth do people really using those model or just for the concept of talking about it in the industry? And what kind of model do you use?
And this is what I use. This is
Okay.
absolutely what I use. And I would tell you that this is how, this is how when I was working for David Tepper at Appaloosa, this is how we evaluate things. You'll see next week why I think this is exactly the rule that Buffett uses. I think we showed you, or at least I think I demonstrated why, at least I think this is how Peter Lynch thought about stocks with his rule on when to buy bonds. But yeah, no, I think there's a lot of people who understand this rule intuitively, and I think there's some people who use this rule explicitly, but I think there's a lot of people who actually use this rule.
But usually people saying is that if there's a rule people will follow, then that rule will be invalid pretty soon.
Well, this isn't so much a rule. This is just math, right? I mean, I think I showed you that this is everything. Everything here is just derived from a mathematical equation of discounted cash flow, right? It's just an easier way to do discounted cash flow, right?
Can I say
Some
that
people
way?
a lot of people use multiples, right? A lot of people use multiples. And like I said, and again, I don't want to get into it necessarily in this class, but I'm happy to kind of tackle it over Canvas is, every PE multiple, EV to EBITDA multiple, EV to sales multiple, you can basically derive it through discounted cash flow. And so I can convert the discounted cash flow function into these multiples. And so some people just intuitively use multiples, but they're still using discounted cash flow. And then Gordon growth is effectively just another derivation of the discounted cash flow. So they're all mathematically identical.
So can I say this one is it is a concept, it is a mathematics, but different people using the same mathematics will come up with a different number.
Sure,
the assumptions are different,
but
right?
that's a function of just what assumptions people are willing to make, right? And also, right, like I said, also a function of like your personal view on what's an acceptable rate of return, right? Like I said, somebody, today a retiree whose option is maybe investing in T-bills might think anything above a 3% return is really, really good. And so everything is below intrinsic value. And some venture capitalist whose alternative is investing in maybe like some really high growth AI company or whatever, where he thinks he's going to make a lot of money. No, I said he thinks he's going to make a lot of money. He might say, even a 20% return is he'll turn his nose up at that. So, again, this is where investing it becomes a little bit more personal than I think people, there's no one number that fits everybody, right?
Yeah.
The market is made of a bunch of individuals who all have personal preferences and things like that. And then the market kind of acts as a clearing mechanism. Now, what I'm saying is that you can just use it to read where you think the implied returns are, and then you have to decide for yourself, is that return attractive enough for you?
Makes sense. So the assumption really is the difficult part and also the tricky part. And it depends on the assumption, really.
Well, I mean, like I said, I think there's some limiting factors. You wouldn't want to assume a growth rate higher than GDP, right? Because again, like I said, it just, mathematically it doesn't make sense for that. And then the other part of the equation is the earnings yield, right? Which is actually just a given number, right? It's just earnings today divided by today's price. So, you have one number which is given to you, or you can derive it pretty quickly, and the other number which you have to make an assumption, but at least there's some guardrails around what are reasonable levels of assumption to make. And so at least that'll give you a reasonable, you may not come up to with an exact number, but you can have a rough kind of range, right? Where you could say like, my returns are going to be between 7% and 11% or something like that. It's not 0 to infinity. MD, let's ask, you have a question?
Yeah, I'm just asking, I have a question about Charles' question. Earning, do you think it is a normalized earning, or just the day you calculate the value, that day the earning?
I mean, it should be the normalized earnings, right? Because you're using the normalized earnings to then calculate a normalized growth rate for all the future earnings, right? If you look at that equation, it's e to the E0, E naught times 1 plus the growth rate, et cetera, et cetera, et cetera, right? So you want it to be a normalized earnings number, not
What about the price? Is it a normalized price or just the price of the day?
No, it's the price of the day.
And then the GDP growth rate. That's how you're finding out that probably will be the answer.
I mean, again, I mean, I think, in the example that Peter Lynch uses, he uses a little bit higher growth rate, but he uses a dividend yield. Again, it's not a science, right? This is a little bit more of like an art where you have to make some reasonable assumptions. But I think hopefully I've told you, we could talk about it, some more, but I think that, and personally what I would use is a normalized earnings yield and a GDP-like growth rate. Now, we don't know what GDP growth will be like, right? It could be a lot higher in the future, right? Maybe AI creates this huge productivity boom and GDP growth is higher in the future, right? So, I mean, we're using 4%, or I use 4%, because if you look over time, GDP growth has averaged around 4 to 5%, even during periods where you had a lot of innovation, like the tech bubble and stuff like that. So I don't have any real hard reason to assume that GDP growth in the future would be a lot higher or a lot lower. But again, that's an assumption that you have to make. And maybe you have a different reason and you believe that the number should be a lot higher or a lot lower. But that's, that's where that's where investing becomes a little bit personal. But that's also where I also think that, when we talk about the Buffett kind of reasoned rule, I think the whole reason he says, I want an earnings yield that alone provides me an acceptable return, is because the growth is the more uncertain portion of it, right? So if I can make, let's say 7, 8, 9% just from the earnings yield, maybe that's okay. Maybe I won't do great, but I won't do badly. Again, as long as I'm right that the business doesn't decline and at least can stay stable, right? And then if growth does happen, which probably is the most likely assumption, then you'll do something a little bit better, right? And instead of being so precise, right? Like what he said, it's like, I don't need to know exactly how much the man weighs to know that he's fat, right? I could see that he's fat already with kind of an attractive earnings yield, and then if I could growth on top of that, it's a bonus.
What's the growth like? You meant like, is there revenue growth or the earning growth?
Well, I mean, look, over time, revenue growth and earnings growth should track one another, right? Because margins can only go up, they can't go up forever and stuff like that.
And the question I had originally, the margin of safety, what is the percentage?
Sorry, and let me, because I see Charles still has his hand up, so I just want to make sure he doesn't have it. I just want to be fair to everybody. So Charles, do you have another question? Because I see your hands up, and if not, I'll go back to MD.
I'm sorry, I should put it down. I'm sorry.
Okay,
Yeah.
that's fine.
Yeah,
okay, MD.
Yeah. What's the margin of safety? Like you said that earning yield should be higher than the bond yield. Like how do you know, like what point do we think that this has enough margin of safety?
Well, I mean, again, I think that's where you have to look at it and make it a little bit of an assessment yourself. But like, today, let's say, treasuries are at 4.5%. An investment grade corporate bond long term would be about 5.5%, right? So 5.5% would be something less than 20 times earnings. So if you saw a company that was trading at less than 20 times earnings and growing, that might be a reasonable margin of safety. But maybe you want to have something even lower than that, because you don't know if interest rates might go up and credit spreads might increase and things like that. So I personally think that a good rule of thumb for margin of safety is just if I can make from the earnings yield what I think is a reasonable equity return, right? So let's say 7%, 8%, 9%, that gives you a margin of safety because, you have a long history of that being kind of like, the return of just owning equities with growth, and, you're getting that without growth.
And so that means you're comparing between, say, 7% with 5.5%. So that's enough margin of safety.
Again, to me, that seems like a good margin of safety, but for somebody else, for you, maybe you want to have more or less. Right.
Okay.
This is again, this is where it becomes a little bit more personal to your, to your level of comfort and your risk tolerance, if that makes sense. Right. Just like what we were saying before, right? Somebody might say, a 3% return is a really good return, or a 4% return is a really good return. And other people might say it's a really bad return, right? And again, it depends on your risk tolerances and your personal preferences and your opportunity cost.
So what do you mean by that safe earning yield and riskier growth yield? Like you divided that yield into two categories.
Well, if you look at the Gordon growth equation, right? R equals E over P, the earnings yield, plus G, right? So the earnings yield is something that you can know or you can calculate today, right? And then the growth is the uncertain portion of it, right? And so you don't know if a company is going to grow, 5%, 1%, because you don't know what the world necessarily was going to do. So that's the component where you have more uncertainty on. The component that you have less uncertainty on is the earnings yield.
Okay. And then Warren Buffett I saw a concept Warren Buffett talks about owner's earning. That means earning plus depreciations minus capital expenditures. Did you mean by that, or just the straight earning?
I think we don't need to get into that technical detail, but I don't think it really matters for most things. But just the earnings, the reported earnings of the company. So you could just use the reported earnings of the company. You don't have to kind of worry about these owner earnings and things like that. Since we've gone kind of meaningfully over, again, I want to be sensitive to everyone's time. Again, I will urge people that please submit questions on Canvas. I'm happy to tackle them all week long. And I look forward to next week. So I hope you enjoyed the class today.
Thank you very much.
Thank
Really
you.
appreciate it.